I jokingly say that in those days, I didn't know the difference between a letter of credit and a line of credit. And I used to get assets and liabilities mixed up, and I still do. But we were going to school in a very first principles way on how banking works and where money is made. And I reference this often, a book by a McKinsey partner called Lowell Bryant, and the book was called Breaking Up the Bank. What he basically did, and this is part of what we did as consultants, was take all of the businesses that are in banking, break them into their constituent parts, allocate not only overhead to them, which is a process that would often be done, but then allocate economic capital, not regulatory capital, economic capital. How much economic capital would you need? And then look at where the shareholder value accretion is occurring. And what we found time after time, we worked for Chase and Citi, we worked for Wells Fargo, I think, and Chemical Bank, a whole bunch of the mainstream banks, is that time and time again, you would find that economic rents above the cost of capital were being made in unsecured credit. And unsecured credit was growing. Mm-hmm. And unsecured credit was going through a renaissance where, on the one hand, you had Fair Isaac, who was starting to collect 300 variables on every consumer. And that data was very predictive in terms of actuarially who will pay back and who won't, and the bits in between. And relational databases were emerging. So you could now amass large data sets and then attack that data with, usually on a batch basis, with SAS and SPSS type packages. So yes, I think so much of the root of what became Capital One in its DNA went back to those SPA days and the training that I had prior to coming into consulting. In my view, it is fanatical focus on unit economics comes out of our background in understanding actuarial analysis. And when I was at SPA, we did work for several insurance companies talking to actuaries about how they did what they did. So I spend $1 today and then I will get these returns back, and then I use an appropriate discount rate and I can come up with a net present value per customer, which to me is the holy grail of lingua franca of how do you evaluate different ideas, not LTV to CAC, not other ratios that people use, which is shorthand. NPV is the real McCoy, and that's how you should do it. So on the one hand, it was that. The second thing that we applied was the scientific methodology of developing hypotheses through observation and through past hypotheses, and then testing those hypotheses out in classic Karl Popper language. You would look to try to disprove the hypothesis. Today, all too often, and clearly in a world of advanced AI, a lot of people just throw a lot of spaghetti against the wall and see what sticks. We were very hypothesis driven. So a combination of this fanatical focus on unit economics and then real A/B testing, where we did thousands and thousands of tests in real time. I think I once described Capital One as a giant experimental laboratory, agar jelly in real time. So any conventional wisdom, you would test to see where it worked and where it didn't work, and when the conventional wisdom would run out of gas and where it would start to break down. So the learning that came from that was just massive. And that led to breakthroughs in terms of risk-based pricing, which if you and I went to the insurance company to get insurance on our car, we would get different prices, right? You're younger than I am, therefore more risky. You drive around in that beautiful red Maserati that I see outside now as I look out of the window, and I'm driving around in an SUV. We would get different pricing, and we understand that. But in credit cards at that time, 1980, everybody got the same price, $20 fee, 19.8 annual percentage rate. So risk-based pricing was one breakthrough. The second one I think that was really powerful was the ability to put together teaser rates. I'll give you a lower rate for a period of time, and balance transfer apparatus so I could move your balances across. And that led to us being able to attract positively selected customers on a giant scale. And the third one is really for opening up the near prime and subprime space. Half of America today can't get access to a credit card from the mainstream banks. And they couldn't in 1988 either. So those three big breakthroughs allowed us to be able to scale then at Signet Bank, that led to the spin-off of Capital One. But the DNA, it was very much, if I would add back to the DNA that is Capital One, and now that Capital One diaspora spread all over the planet. I'm very proud of the people that came out of that grist mill. It's that relentless focus on getting the analytics right and being insatiably curious, and then figuring out how to mobilize those insights with technology, with product, with scaling.